Hey, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounder Show. As I was just about to start filming, I got a bout of the hiccups. So if you hear a little burp or a Kermit the Frog popping up, that's what's happening. Anyways, Google just posted their earnings, and the market did not like what they heard because they effectively went from $206 a share down to like $189, $190. And in this video, I'm going to articulate why I think this might be a buying opportunity. I'll also talk about how much I think Google is worth right now and my own personal buy price target. And alongside with Google, we're also going to talk about Hershey and Huntington Ingalls, which are two companies that I'm currently dollar cost averaging into. There's a lot to talk about. Let's go ahead and get into it. First off, I just want to say thank you, and I appreciate all of you who commented on my AMD earnings video and told me like, hey, it's okay, and because you guys reminded me that fortunes are made when the market overreacts and the companies that are otherwise high quality go on a sell-off, you can buy them on a discount and at a bargain. I thank you for that reminder. Also, for all of you that gave me feedback on this poll, I asked, what are you doing right now in this week when there was a lot of tear-off, sell-off, noise, and overall fear and doom in the market? 89% of you told me that you are going to continue to invest as usual. So the feedback from the AMD video and this poll reminded me that I shouldn't sit on the sidelines with my cash, but instead I should be seizing the opportunity to be buying into these companies that are going through a sell-off and a temporary dip. So thank you so much. Now with that said, let's get into and talking about Google. So their quarterly earnings for the past 90 days, how did Google do? Well, they dropped by, as we alluded to earlier, by 9% once they reported. The stock market was not very happy. And as you can see by this bullet point right here, they also announced that they're going to do $75 billion of additional capex, which is a lot more than what the Wall Street analysts were anticipating. And when we look at the numbers, right, they missed on the revenue, right? They posted $96.4 billion. They wanted to see $96.5 billion. And I'm going to talk a lot about why they missed and why I don't think it's such a big deal. But more importantly, why I think Wall Street is overreacting. And then when we look at their earnings per share, they posted $2.15. The expectation was $2.13. So when you think about it, their earnings per share are looking a lot better, which means they're having increased margins across the board and they're becoming even more profitable than they are right now. Their YouTube revenue, they crushed it. Hey, YouTube, this is your sign to pay me more. You're not paying me enough. I'm being serious when I say that too. Their cloud revenue, that's where they missed. And I'm going to talk more about why this revenue missed because of the cloud here in a second. And this might be controversial to talk about, but alongside with their earnings, Google also announced that they're reversing course on their DEI endeavors. And now they're going to say, hey, we're going to hire based on skill or qualifications instead of putting someone into a seat who doesn't deserve to be there. So instead of looking at the race, gender, and sexual preference, now they're going to try to operate with merit. And on paper, who deserves to be there because they're going to be a value add to the company instead of being a hindrance and something that holds them back, especially to the team that the individual is attached to. Whether or not you think this is a good thing, I guess we'll see. Time will tell. All that to say, there are other major corporations out there right now that are also reversing their decisions on DEI endeavors because they're realizing that DEI is not exactly the most profitable thing to do. And so whether or not you agree with this, in the long run, this should help Google's margins as well as their productivity and output per employee should increase. In theory, that's why they're probably doing this. And now let's go ahead and look at their earnings report to see what we are working with when it comes to Google. And by the way, I want to say Google is an example of one of those companies that does not invest into the theatrics and putting out a very visually appealing and aesthetic presentation for the quarterly earnings report. Instead, they focus on the business and the operations rather than trying to be all flashy and put on a show. So instead of having a very engaging and interactive earnings presentation, they let the numbers do the talking. And they're not alone. Even in the Mag 7, I would argue Meta is the same way. When you pull up their earnings presentations, it's also black and white and very boring. However, the numbers are what should excite a potential investor or analyst. But anyways, when we take a look at their numbers, right, what we are looking at right here is year-over-year change in revenue. This is what investors call the top line. It grew by 14% year over year. That is bonkers. So double-digit growth in the revenue. So $307 billion all the way up to $350 billion in 365 days. Absolutely wild. This is the definition of a cash cow machine. And when we look down right here at their operating margin, it went from $84 billion to $112 billion. And that's why I was talking about earlier, their earnings per share is only going to get better and better in their next quarterly earnings report and for the next year, or I guess this year in 2025, because the operating margin went from 27% up to 32%. That's a huge increase. I don't think you guys understand. As a guy that used to work in logistics and supply chain, for your margin to increase that much year over year, that is absolutely diabolical. Crazy talk. Case in point, when we take a look at their earnings per share for the full year, it went from $5.80 up to $8.04. So all I'm trying to say right now is their pitiful, tiny little dividend that they pay, I think the payout ratio prior to this earnings report was like a 9%. Because of this even better earnings per share now, that payout ratio is now about to become like 2%. And I'm not exaggerating. That's the power of increasing your margins and improving your earnings per share. As we look at their business segments and the money that it generated broken down, so Google search and YouTube, we're just going to categorize into one thing as Google advertising. That revenue went from $65 billion up to $72 billion. Absolutely wild. And when we think about all of their phones, devices, tablets, subscription model stuff that they have going on, and you think about that as well, that went from $10.7 billion up to $11.6 billion. And everything else down here contributed a little above $12 billion, but it comes nowhere near their main bread and butter, which I would argue is the Google advertising line of the business. So when you think about it, right, their advertising segment prints so much freaking money that every other endeavor that they do, they even put a line item for that, right? Other bets. And by the way, I go in a deeper dive and I articulate what exactly they're trying to do in my Google stock analysis video. So watch that one for more information. But every other endeavor that they do is literally just a side quest. But what I love to see here is that because they know the advertising line of business makes so much freaking money and that it grows at a pace that is reliable and is consistent year over year, they're gonna grow. It shows me as a company, they're fundamentally resilient, adaptable, and innovative. And I say that because when you think about it, Google has built and shut down more innovation than most tech companies have ever thought of. Google is a company that literally has a portfolio of graveyard apps and platforms. They literally greenlight a project just to kill it 6 months later. They have so much money on hand, they're willing to take gambles and bets. So rather than taking it easy and being complacent with their advertising line of business, because when you think about that, if they just had Google search and the ads associated with it, this would still be a very high quality tech company. But they're not stopping there. They're choosing to be innovative like I just hinted at, right? When we thought about ChatGPT, when that came out, Google stock literally got smashed and crushed. Everyone across the board was fearful and saying, oh, who is ever going to use Google search because now we have AI and ChatGPT automating the thinking for us, and in the search process, let's go ahead and crush Google's stock price. Well, what did Google do as a response? Did they sit back and act like Intel and let their kingdom fall? Absolutely not. Google has one of the best intangible resources that any company in the world would be envious of, and that is having the best and the brightest minds and engineers and researchers working on their behalf. That is such an asset you don't even realize. Human capital and the people that comprise your workforce, that's what makes your company the shining gem that it is. Anyways, as a response, Google pushed out their own AI search tool called Gemini AI. And then of course, when TikTok came out, right? Everyone was fearful and saying, oh, YouTube is cooked. How are they ever gonna compete with TikTok? Well, what did Google do? They pumped out YouTube Shorts. And lo and behold, 2 years later, now YouTube Shorts has gained traction with Gen Z, and it has numbers across the board that's growing and is profitable. So Google is a cash cow machine that as an investor, it just makes no sense as to why the market is punishing Google as hard as they are right now. As we look at their numbers, their market cap, okay, it's a little high at $2.3 trillion. But for being who they are and what they do, I think this is justified. And as we scroll down and look at the trading multiple, this is what blows my mind. This is like putting a thumbtack right through my right nipple. Their current trading multiple is a 23.8. Their forward trading multiple, their PE ratio, is a 21. Remember those numbers because now I'm going to show you some of their numbers and fundamentals. As we look at their income statement, look at the growth of their top line. It's essentially going from $182 billion fiscal year 2020 during the pandemic to what it is today at $350 billion. This is literally the definition of a dividend compounder with cheese. Your money invested into Google is literally going to 2x, 3x, 5x in a span of X amount of years. And I don't know if that's going to be 5 or 10 years or maybe even 20 years. But a company that is growing at this pace, that is this consistent and reliable and predictable, their stock price is going to follow the fundamentals. And as we jump over to look at their balance sheet, I really have to call this out. I don't think people understand how amazing of a company that Google is. It doesn't matter how you feel towards YouTube or Google search. Think about it like this. They're cash and cash equivalents, meaning if they were to liquidate all of their little bonds and treasury notes and everything else that they have on hand right now, they have $95.6 billion of cash and cash equivalents. Keep that number in mind, and their trading multiple of a 21. Okay, their PE ratio, 21. As I scroll down to show you their total debt, it's $28 billion, correct? So using their cash and cash equivalents on hand, if they were to pay off all of their loans, all of their debt, and their accounts payable, they would have $67 billion of cash, cold, hard cash left over. From my understanding of business, having worked in corporate America at 2 different Fortune 20 companies, you literally cannot go belly up if you have more cash on hand than loans, unless you face litigation and lawsuits and scandal after scandal. Then of course you can disappear. But for the most part, $67 billion of net cash to debt on hand. Their financials are absolutely ridiculous. And the next thing I want to show you is their cash flow statement, because before I show you what I think Google should be priced at and what price I'm buying them at, you got to understand what I use to reach that number, which is their free cash flow and the growth thereof, right? Free cash flow essentially, let me see if there's a definition here that shows you. Is the company, through their operations, generating cash, and are they profitable? That's basically what this metric tells us. Their growth of their free cash flow is just absolutely wild. In 2020, it was $42 billion of free cash flow. That is ridiculous. There's so many S&P 500 companies out there where in a fiscal year, they don't even reach $42 billion in revenue, let alone in free cash flow. For Google, this is their free cash flow. This is crazy. And as we fast forward throughout the years, now it's $72.7 billion of free cash flow. All I'm trying to say is that the investing thesis for Google writes itself, especially if you want to label yourself as a value investor. To see a company that is this cash heavy, to have a balance sheet that looks this fortified, even Jamie Dimon's little PP would get super rock hard at saying how spectacular the balance sheet looks, to see their economic moat, to see their trading multiple at a 21. If you truly claim to be a value investor, I don't understand how your nipples are not lactating milk right now as you look at this presentation and this video. And before I reveal the price that I have in mind for Google, let me explain what I was talking about earlier with how they missed their revenue due to their cloud segment of the business not meeting the expectations, and why I think Wall Street is technologically illiterate. So as we jump back to their earnings press release, the company is now going to do $75 $75 billion in capital expenditures, right? This is what investors refer to as capex. When you think about capex, it's literally laying down the foundation today so that in 10 years or 20 years from now, you can sit in the shade when it's a hot ass day and your armpits are all sweaty and the humidity is making you regret your decision to move to Thailand. But anyways, laying down the foundations today through building out an infrastructure, building out software, warehouses, a logistics network, whatever it is so that you can sustain your growth. However, Wall Street heard that and was like, dude, I want nothing to do with Google anymore. I don't care about your free cash flow. I don't care about your economic moat. I don't care about all of your other project endeavors. We wanted to see a number that was around $58 billion for your capex. To tell us that you're going to do $75 billion, we don't like you. And this is why I think Wall Street is literally stupid. Because when I tuned in to the earnings call, I found out why they missed their revenue through their cloud segment. It is because right now, Google does not have the infrastructure in place in order to meet the cloud and hosting demand that they have from consumers and their corporate client customers. So they need to build more servers because they want the growth story to continue and to future-proof their business model. That's why they're increasing their capex, as it says right here, $75 billion in 2025. The reason why they missed their cloud revenue and the reason why their revenue came in short overall is because they don't have enough infrastructure in order to meet the demand that is required of them. So to punish Google for building out more servers in order to grow their cloud revenue this next year and the next 5 years, dude, you're literally stupid. You're being unreasonable. How the heck is Google supposed to grow their cloud revenue if their servers that they have right now are completely maxed out? Their bandwidth, it can't meet the demand. And you're saying, grow it. I don't know how, but just grow it. Dude, you're being so dumb. So anyways, as I calm myself down, let's answer the question. Why did Google miss their top line? Case in point, their cloud revenue. Because Google currently has more demand than available bandwidth. If you were to ask me, even if you don't understand business, even if you were to ask your cousin who does not understand anything about numbers in the stock market, he would also agree that that's bullish as heck. This is a company that is literally going to double and triple their cloud revenue as soon as they get more servers and infrastructure built up. The capex, in my opinion, makes a ton of sense and is the right business decision to do. I guess playing devil's advocate, what Wall Street wants to see is for Google to increase their prices across the board while maintaining their capex timeline of like, well, what was that, like $50 billion? But no, instead, Google is playing the long-term game of offering competitive prices. That way, as they build out their infrastructure and gain more traction and more market share, then they can start thinking about raising the prices. You need to think long-term and strategically, just like Costco. For so many freaking years, even when investors were pressuring and saying, you're being dumb, you need to raise the price of the membership subscription fees, do it. We hate you. Think about the margins. And don't even get me started on the food court and the hot dog being $1.50 and investors jumping up and down and being short-sighted, wanting to see the short, fast growth in the next 3 months and saying, raise the food court prices. Dude, they're being so stupid. Instead, Costco played it long-term, strategically, kept their prices competitive, and as they gained more trust and rapport with the customer base, then and only then did they increase the prices. That's what Google is doing as well. When you see a company that caves in to the demands of the analysts and idiots that are short-sighted, I would question the leadership team and the management that is running that company. However, when you have leadership like from Costco or from Google that understands and sees the bigger picture and the bigger pot of gold at the end, because right now, would you rather them grab a handful of brass coins, or would you rather them to be patient, play the long game, and in the end, grab that bucket full of gold coins to the point where both of your pockets are full, both of your handfuls are full, so you got to put some into your anal cavity. That's what I picture and I want to see in the future of Google, to play play it smart, to play it long term. Wall Street, you're being so stupid. I'm going to say that right now. And another headwind that they have, because as they say, when it rains, it pours. So not only did they miss their quote unquote revenue and Wall Street is overreacting and being drama queens, just like I was when I made that AMD video, China also announced that they're going to investigate Google for violating antitrust laws, which I think is hilarious because Google is all about free speech. And then some people say, oh, but Google does censorship and you guys are so bad for that. However, China is the epitome of somebody that does censorship, right? So as a result, Google does not operate their search business in China. So come to find out, China still comprises 3% of Google's overall revenue. Reason being is that there's people located in China, they have companies and businesses that pay Google to put ads out on their behalf. So their advertising line of the business, those ads will be shown in Europe, Africa, Southeast Asia, in the US, Canada, and also the Android marketplace. And don't even get me started on that economic toll booth monopolistic thing that they have through the Android Google Play Store. Like Google's business model is so spectacular, but of course that's also something that they are dealing with. So it's not only Europe calling out Google, it's also China saying, hey, Google's business is so big and scary that we need to probe them for violating monopolistic antitrust laws. When I hear that, I'm bullish. I am so freaking bullish. So now that takes me over to what I believe Google should be worth right now. Because I'll tell you what, Google is absolutely undervalued at $191 a share. This is wrong, okay? Their trading multiple should never be a 23 for a company that is growing as fast and as predictable as they are. However, with that said, based on my math, calculation, and analysis, doing a discounted cash flow analysis model, I think that in the next 6 to 12 months, Google should be worth about $228 a share. Are they near that number? Not really, kind of, but not there. And if you are one of the rare people out here that are not invested into Google, then my personal buy price target for them with a margin of safety baked in, that way you have a little bit of risk allocation set aside, then I would argue a good buy price for Google right now would be around $182 a share. Yes, they are slightly above that at around 190, 191, but I'm gonna say this. I sold out of Google a few weeks ago so that I could use that capital on hand in order to buy into other investments. And I personally decided to jump back in once the sell-off happened, once Google was trading for around $190 a share. So that's how highly I think of this company. Not only did I sell out of them, but once I saw the sell-off happen, I was like, well, I guess I'm gonna be an investor of Google again. So even though I think the good buy price target is around $182, I personally decided to jump back into Google while it's on a dip and on a bargain discount at $190. Now, do I think that's the best deal in the world? No. However, when it comes to Google, buying them on the dip is not exactly the worst idea either. Because I think Google is such a high quality company that in the long term, when I say long term, I'm not talking about next week. I'm not talking about next month. I'm talking about when you get more gray hair in your pubes and your armpit hair starts turning white, 5 years, 10 years from now, your money in Google is going to compound. That's without a doubt, unless something fundamentally changes and Google becomes really sketchy and they lose all of their profits and all of their margins and all of their business models goes out the window, which, do I really see that happening? No. Google is not going to crash and burn. And as I was saying earlier, if you label yourself as a value investor, I just look at Google as common sense investing. Not only are they compounding, not only do they pay a dividend, not only are their financials and balance sheets super crazy with an economic moat beyond belief, this company has a trading multiple of a 21. When I say common sense investing, I'm saying, doesn't that make a lot of sense on paper? If you were to replace the name of Google and slap something else on there like Procter & Gamble, and you saw that kind of numbers in their free cash flow and revenue and their debt situation, dude, your nipples would be super rock hard. Just because it's Google does not mean that sentiment should change at all. Case in point, this is common sense investing, right? When I pull up Palantir, their trading multiple, friends and family, is 585. Their forward trading multiple, this is the PE ratio, is almost 200. And look at their fundamentals and financials. Yes, it's pretty. However, is it anywhere near the growth in the numbers of Google? $2.8 billion for their revenue? Absolutely not. When we take a look at their free cash flow, it's $1.1 billion. And when we take a look at their balance sheet, their cash and cash equivalents, $5.2 billion, and their debt is $239 million. So it looks like Google, but on a very much smaller scale. The point that I'm trying to make is that as you look at this $2.8 billion revenue in the past 12 months, to see a market cap of $253 billion, this is absolutely bonkers. This is not common sense investing. What I'm trying to say to you is, if you were to blow up Palantir's scale and their numbers to the proportions that it is with Google, because almost everything else looks pretty much similar, right? If Google had a trading multiple of about 585, and the forward trading multiple was almost a 200, could I stand before you here today with an honest heart and say they are undervalued? No, I could not. I would be like, dude, you might want to pump the brakes and think about whether or not this is going to come tumbling and crashing any second. Because this, I don't know if this is sustainable, friends and family, if I were to copy and paste Google right here. However, Google is nowhere near those numbers. Google's trading multiple is a 21, in the same category with like Procter & Gamble, Johnson & Johnson, and all these other old antique companies whose numbers are not growing as fast and as predictable as Google's. This is ridiculous. So what I'm trying to say is, are they undervalued right now? Yes, ever so slightly. I'm not saying this is the best bargain deal that you can grab on the market right now. However, on the dip, on the decline for a company that is as predictable and with a future as bright as theirs, I don't think it's the worst idea in the world. So to explain the thumbnail, I don't think Google is cheap right now, but I definitely think it's a better value than Palantir, and especially in comparison to the other Magnificent 7 tech companies. And before you think I'm being delusional and optimistic when it comes to Google with a price target of $228 in the next 6 to 12 months, as I scroll down to show you what the Wall Street analysts think, they're saying Google is worth $212. So even by their metrics, Google is currently undervalued. And the lowest price target, the guy who is the most bearish, hates Google, thinks about them going bankrupt, even he thinks Google is at least worth $181, which is not too far off from what I said is a fair price target to buy into Google. However, I'm gonna say it one more time. I decided to buy into them when they dipped down to 190 because I still think it's a good deal. I think anything below 190 is a good deal. 182, a steal. If you can grab Google at 170, or if you one of the early investors and your average share price is like 100 or even like $80, dude, you are invited to the cookout and I will buy you a round of soju on me. You are invited to eat some kimchi, some bulgogi, and some kimbap. I will buy that for you. You must be so happy. Congratulations. That's what I would do. And I'll say this before we move on to Hershey. When you decide to invest into Google, not only do you get the stability of their search and ad revenue model that you saw that generates about 80 to 90% of their total revenue, but you also invest into their big bets, such as DeepMind, Waymo, and Calico, which is their anti-aging technology business. There's so much more about this company that you don't even know. Watch my Google deep dive video as to why I sold out of them and then decided to buy into them again this week. This is a company that I believe in. All right, as we move on to the first of the two companies that I also decided to dollar cost average into, let's go ahead and talk about Hershey. They also posted their earnings this week, and it was nothing short of beautiful. Hershey's earnings per share estimation was $2.37 for this quarter, or the past 90 days. Instead of just meeting it, they absolutely smashed it by posting $2.69 instead. And their revenue expectation was $2.84 billion. They said, okay, not only will we meet that, we'll also smash that at $2.89 billion. The reason why this is so impressive is that this is a company that is facing headstorm, obstacle, and speed bump after speed bump. Hershey, for the past 2.5 years, has been having the worst luck ever. And still, in light of it all, because it is such a high quality dividend compounder with cheese, they are finding a way to smash and to grow and to thrive. This is exactly why I am buying into Hershey. So prior to the earnings report, they were around like 144, 145 a share. After Hershey showed the light at the end of the tunnel to the stock market, they jumped up to $152 a share. And I don't think that positive sentiment is going to end right here. As they are right now, their trading multiple is a 13.9. Historically, for Hershey, this is really low. This is a CPG company that usually trades at a premium because of their portfolio, their financials, and fundamentals. Speaking of which, you want to take a look at this. A company that is facing as many headstorms as they were able to grow their top line year over year for the past 5 years. And not only that, as we jump back to their earnings press release, their earnings per share increased year over year at a rate of 33%. This is absolutely diabolical. This is crazy. However, what I do want to call out is they are facing margin issues. The cost of cocoa, the prices are at historic highs. And as a result, their margins are just being crushed and devastated. When you think about it, Hershey, I would say a bulk majority of their portfolio, they utilize cocoa as a raw ingredient for most of their candy. However, they also started to branch off and diversify by having savory and crunchy snacks like popcorn and chips. But for the most part, Hershey is associated with their candy, and their price for the cocoa is crushing them. So as a result, when we think about this next year, I guess fiscal year 2025, they're expecting their revenue only to grow by 2% year over year. They say at least. That means at a minimum, they're expecting 2%, which means they're probably gonna post something closer to like a 2.1 or 2.2%. But it's better to be a little more conservative and play it safe, especially with your communication and message, so that if you exceed it, it's seen as a positive. Whereas if they were to say something stupid like, you know what, guys, we can post 6% growth year over year, and they end up posting 2.1%, dude, you would fire the entire FP&A team, you would fire the entire accounting team. Everybody who gave you those stupid numbers need to go right through the door. So it's better to play it safe in your messaging. That's what Amazon does as well. They always give bearish guidance and forecasts and then just smash it every single quarterly earnings report. Is that the right thing to do? No, but it's better to play it safe than to be sorry. And as a result, because now you understand why this company is going through a sell-off for the better part of 2 years, is because of the price of coca, and then of course the Ozempic crisis, and then the JFK, sorry, is it JFK or, RFK Jr. hire and his war on food ingredients. Hershey is just having their balls squeezed to the point where one of them might pop. So they're expecting their earnings per share to go down by roughly 40%. Yes, their margins are going to be smashed this upcoming year, and not in a good way. So as a result, they're expecting their earnings per share to be in the ballpark of around $6. So using this number right here, one thing that I do want to call out is their dividend health, which before we get into, if we take a look at their earnings per share in 2023, it was $9.59. This number should have grown to like $9.80, but we're going to give them a pass because we understand why they're suffering right now because of the coca prices. Now, their earnings per share is going to decrease to $6, as they said earlier, down by 40%. So as a result, when we look at their dividend profile and it says, hey, we pay a 3.6 dividend yield, which is pretty good, pretty juicy, and you look at this number right here, this is not accurate, friends and family, because as we take a look at this $5.48 dividend payout and we divide it by that $6 earnings per share for this next year, off of the assumption this dividend is not going to grow. If I were a part of the leadership team, I would not grow this dividend because it's better to have a sustainable dividend than it is to grow it and then to cut it. If you cut your dividend, you are literally shooting yourself in the foot and the market is going to punish you beyond belief. I've seen it happen again and again. So it's better to just sustain it at $5.48 for at least one more year as coca prices stay at historic level highs. So as we do the math, the real payout ratio is going to be closer to this, a 91%. Now, as a dividend growth investor, that makes me feel concerned and a little worried. However, the earnings per share on the low end should still be able to sustain the dividend. And when we think about it on the high end of $6.18, then the payout ratio is going to be closer to an 88, which is still a little high. However, do I see them cutting it? Only time will tell. I'll say this, if 2026, they continue to face pressure and cocoa prices go up even more, then I think the business decision should be to cut the dividend so that the business does not fail. It's better for them to cut the dividend than it is for the business to crumble, in my humble opinion. The dividend can always come back, but I don't want to talk about fear and doom and the dividend being cut when there's no messaging saying they're going to do so. So I just wanted to put this out there so you are aware that the dividend payout ratio is getting up there, but I think it's only going to be this high for 1 year, which is 2025. As cocoa prices come back down from inflation and supply chain stuff gets a little better, I think their margins and earnings should improve. Because if we are going to be honest, they already forecasted this year is going to be the worst thing they're ever going to face. So at least they're being transparent and honest up front and telling us and keeping us in the loop like, dude, things are going to get sticky, it's going to get hairy, but if you want to come down here and shave my leg hair and put it on your head and super glue it and pretend it's your hair transplant, then let's do it together. We're in this together. So in the spirit of transparency, I am dollar cost averaging into Hershey because as I think about sectors that are on a discount compared to the rest of the stock market, there are sectors right now because due to the high inflationary environment or other stuff going on, they are on a massive discount. There's REITs, pharmaceutical companies, which I would never touch. If you want to know why I just said that sentence, watch my video as a guy who used to work in a pharmaceutical company, utilities, and food CPG companies. And when you think about food CPG companies, as a value investor, out of that list of 4 sectors that are on a discount, it's probably the most appealing to you, right? But when you think about it, you got companies such as Kraft Heinz, Conagra Brands, Campbell's, Kellanova. You have all of these different food CPG companies. I would argue that Hershey and Pepsi right now are the most undervalued and have the best financials and fundamentals. That's my personal opinion, and that's why I'm buying into Hershey. I don't recommend you follow me into it. This is a company where if things do not improve in 2026, it's going to look really bad for them. As a result, I do not recommend you follow me into this. Please don't follow me into this. For me, I see this as a very good, undervalued buying opportunity as the company goes through a temporary setback. So I'm playing the long game. I do not recommend you follow me. Their total return is 3,700%. This is a company that I know will do fine in the future. Or in 2026, you're going to make me eat my own words and put a sock into my mouth as they go deeper into the red. I don't know. That could happen. As we jump over to talk about Huntington Ingalls, ticker symbol HII, they just posted their earnings and let me just tell you, it upset and pooped into the morning cereal of the Wall Street analysts because they were not happy with what they saw. So if you want the full picture of my deep dive about Huntington Ingalls, go ahead and watch my video about the military stocks that I think are a buy right now because Huntington Ingalls is a part of that list. My personal buy price target for them was around $185. However, after their earnings report, look at what happened. They dropped by negative 18%, and now they're currently trading for about $160 a share. What did I do? I decided to jump in because after reading the earnings report, I was like, okay, does this seem permanent? Is this something that is going to make this company go belly up? Is this going to make Huntington Ingalls crash and burn? Absolutely not. And I'll talk more about that here in a second. This is a company that right now, their current trading multiple is 11. This is absolutely ridiculous for a company that has a monopoly with the United States Navy and United States Coast Guard. They build cruisers, destroyers, submarines, and other vessels, and with a contract in place and defense intellectual property that makes competitors stay away. They have an economic moat, a guaranteed customer and guaranteed income as long as they're good on their end of the bargain. So let's talk about Huntington's recent earnings. Their revenue for the rest of 2024 was $11.5 billion. Their earnings per share was $13.96. Their backlog right now is $48.7 billion of projects that they need to be good on and finish building out. Have they done that? Not yet, and that's what we're about to get into right now. But before we do that, I do want to call out that they did miss on their revenue and EPS expectations, and that's because because, as we jump back to what we were going to talk about, their submarine building costs and reduced labor output, it's eating away at their margins. And as a result, they're not able to produce what they promised they were able to produce on the timeline that they said they were going to be able to do it at. So their revenue picture is not at their full potential. They're not fulfilling their end of the bargain. If the United States Navy wants XYZ built by December, they want it in their hands by December. But why isn't that happening? Well, during the pandemic, do you remember when the Great Resignation was happening and everyone across the world was quitting their jobs and jumping ship and going into another endeavor or industry or trying out a new career? Well, the shipbuilding industry was no different. A lot of the veterans and the ones that understood how to turn a wrench, they quit. Why? They felt like they were not being compensated fairly enough. Case in point, this is the same picture with other defense contractors, such as at like Boeing and other aerospace companies. But anyways, as a result, Huntington Ingalls had to hire a bunch of new hires, people that are new to the craft. And when you think about them, it takes time to train and for them to become efficient, right? To become at the same level as the veterans that quit. So the United States Navy is rightfully pissed off at Huntington, like, dude, where the hell are our vessels that we are trying to pay you for? You need to be good on your end of the bargain. So as of right now, Huntington Ingalls is facing supply chain cost issues, that are still bleeding over from the pandemic, but also labor and human capital output issues. Remember what we talked about with Google? That's one of their best intangible assets, their human capital and their motivation and their IQ and what they're able to accomplish. When it comes to Huntington, I would argue that's their biggest hurdle right now. If they can get the new hires to stay in the picture, to stay in the fight instead of quitting, saying, dude, this is so hard, you're demanding too much of us. Like, if those conversations happen, if they're able to mentor them and help them and train them and they become efficient, I think Huntington Ingalls, their obstacle could become their greatest asset. Can this happen overnight? Absolutely not. So as a result, Huntington is negotiating better contracts with the U.S. Navy right now. I'm guessing for slightly higher pay so that they can compensate their workers better, but also pushing back the timelines so that Huntington is not penalized. Because I'm sure that in the defense contract, it says something like by, let's make an example up, okay? By March the 1st, we want 2 of our submarines in our hands. If not, we are going to deduct 10% of the potential revenue that we are obligated to pay you. There's going to be stuff like that. So instead of like a 10% penalty, I'm sure it's going to be like reduced to like 7%. So they are negotiating better terms. And for their 2025 forecast, Huntington Ingalls is predicting a 5.5% operating margin. As you can see on your screen right now, their margins for the shipbuilding lines of business not looking too good. And I think the bigger reason as to why they're selling off is that Wall Street, they wanted to see a operating margin of around 9%. So to come out and say, I think we're going to forecast 5%, yeah, do you think Wall Street was happy with that? Absolutely not. So with the defense contracting industry, I think operating margins are a huge deal to the Wall Street analysts. Likewise, when it comes to Google, they're smashing across the board, but because, quote unquote, they missed their cloud revenue, Google got punished because the cloud revenue is all that the market cares about and the growth thereof. But now you understand why they missed. But when I think about Huntington Ingalls, do I see this being a permanent issue with them? Absolutely not. The United States Navy, their demand for cruisers, destroyers, and other sea vessels, do you think it's going to decrease, or do you think we're going to grow our Navy as we learn about China's military and their growth? What do you think is going to happen? As we need more vessels, do you think the revenue for Huntington Ingalls is going to decrease, or do you think it's going to increase? That's where all I'm trying to say. And as we look at their dividend profile, it's a pretty juicy dividend yield that is sustainable and it's growing at the rate of inflation, I guess the historic rate. There's a lot to like here, and they're on a temporary setback sell-off and on a discount with temporary problems. At least that's how I see it. So to wrap up the video, this week I decided to buy into Google, Hershey, and Huntington Ingalls. And if you made it to this point in the video, please let me know what your thoughts are. If I'm being stupid, you have to let me know. I don't have much friends in real life, and I literally have no one to talk to about stocks. My wife is beyond annoyed with me whenever I mention the market or business-related news. She is so annoyed that I can't talk to her about it, so you gotta let me know. Is my head on straight? Am I thinking clearly when it comes to these three companies? Anyways, I love you guys. Stay safe in the stock market, and I'll talk to you next time. I'm going to upload another video here in a bit. Peace.